Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. 2 out of every 5 rental listings in America right now are doing something a little desperate. Handing out a free month of rent, a waived deposit, a gift card just for signing the lease. That is not a discount. That's a confession. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. There's a letter sitting unfinished in my drafts folder. A renewal letter. Good tenant. Lease ends in August, and I owe her a number for next year. Monday, we built the system that keeps a tenant from wrecking the place. Today is the other half of management, keeping the tenant at all, because the cheapest turnover is the one that never happened, and what goes in that letter decides whether it does. The concession signal. So before you write your number, read the room, because the market is sending signals most landlords never look at. Start with those concessions. Right now, roughly 2 in 5 rental listings nationally are offering a free month, a waived deposit. Landlords don't give away a month of rent when units are flying off the shelf. They do it when the unit's been sitting. 2 in 5 listings. That's the market saying out loud that asking rents are softer than the sticker price suggests. Now the rents themselves. I pulled our data this week. Nationally, asking rents are up about 1.9% over the past year. Barely 2, and inflation over that same year ran 3.8. So in real terms, rent didn't grow. It shrank. The landlord, who raised 2% thinking they were keeping pace, quietly handed themselves a pay cut. And one detail nobody mentions, rents actually fell from August into December last year, 4 straight months down, before clawing back this spring. That spring bump you're feeling right now is seasonal. It comes off again. Don't mistake the season for the trend. But here's the real point. There is no national rent market. There's only yours. I ran the numbers on the 50 largest metros. 11 of them have negative rent growth. Rents down year over year. Austin down 2%. Denver, Tampa, Houston, Phoenix, Dallas, all underwater. And in that same week, Cleveland is up 4. Chicago up 5. Same country, opposite renewal decisions. Why the split? Apartments. The country just finished its biggest apartment construction wave in 40 years, and most of it landed in the Sun Belt. When 1,000 new apartments opened down the road handing out free months, they set the ceiling for your rent, even if you own a single-family house. That new supply doesn't have to be your direct competition. It just has to be your tenant's alternative. That's the first move, the concession signal. Before you pick a number, you read the market, the concession rate, your metro's real rent number, whether new supply is landing near you. The market already set your ceiling. Your job is to find it, not guess above it. The turnover test. Okay, you've read the market. Now the math, because this is exactly where landlords talk themselves into trouble. Say you've got a good tenant in a $1,900 unit. You're tempted to push $150 a month, call it 8%. It feels justified. Your costs are up. Before you send it, run what I call the turnover test. One question: if this raise costs me the tenant, how many years of the extra rent does one turnover erase? Run it. A solid market reasonable raise, $50 a month, brings in $600 across the year. One turnover, the kind we walked Monday, ran $33.50. Repairs, cleaning, the ad, and a month and a quarter of empty unit. Do the division. That one vacancy just ate 5.5 years of your $50 raise. Now go aggressive. The 150 version, $1,800 a year. Better. And the turnover still eats just shy of 2 years of it. 2 years of an aggressive raise gone to one dark unit. The turnover always wins the arithmetic. Always. Which means the aggressive raise is really a bet. A bet that this tenant stays for years anyway, right after you handed them a reason to go shopping. And if you're that confident they'll stay through a big raise, then you didn't need the big raise. You had a tenant who valued the place. Now, I know, your insurance renewal came in higher, your tax bill came in higher, inflation was 3.8, your costs are real, and they do not care about a soft rental market. I see that. But passing a cost onto a tenant who can walk doesn't recover the cost. It relocates it and adds a turnover on top. The turnover test isn't telling you to eat it. It's telling you a soft market is the wrong year to find that out the hard way. The retention discount. So here's the playbook. 3 moves. Move 1. Find your below market gap, not the gap you imagine. The real one. Pull your metro's rent number, then look at what comparable units near you are actually listed at today, concessions and all. The space between your tenant's current rent and that real number is your raise ceiling. In a soft metro, you may find the gap is 0. You may find it's negative. Your sitting tenant already pays more than a new lease would cost. If that's you, you do not raise. You hold, you say thank you, and you bank the retention. Move 2. Send it early. 90 days before the lease ends, not 30. A tenant tenant cornered with 30 days left feels trapped, and a trapped tenant starts browsing. 90 days is a conversation, 30 days is an ultimatum. Move 3, the retention discount. When you do raise, you price the renewal deliberately below the new lease asking number. You leave a little money on the table on purpose, and you tell the tenant you did. The market rate on this unit is $2,100. Your renewal is $1,975. I'd rather keep a good tenant than chase the last dollar. That sentence renews leases. That gap isn't a loss. It's the cheapest occupancy insurance you will ever buy. And if your costs genuinely climbed and the increase has to land, pair it with something. A new appliance, fresh paint in the main room, a 2-year lock so they get rate certainty, and you get 2 years with zero turnover. A raise that arrives with something attached reads as fair. A raise that arrives alone reads as a grab. Same dollars, completely different letter. Here's your challenge. And like Monday, the timing isn't an accident. We're in renewal season. 70% of moves happen May through August, which means your tenants are deciding right now whether to stay. So tonight, pull 2 numbers, your Metro's rent growth 1 search, and what comparable units near you are actually listed at today. Subtract your tenant's current rent. That's your below market gap, your real ceiling. Then run the turnover test on whatever number you are about to send. If the raise clears it, mail it 90 days out with 1 improvement attached. If it doesn't, send the retention discount number instead and say the line out loud, I'd rather keep a good tenant. Back in episode 111, I told you to stress test your portfolio for 0 rent growth. This is the year that stops being a drill. The landlords who raise like it's 2021 are about to fund a lot of empty units. Don't be the comp that proves it. This is Martin Maxwell, Prime Investors. Go read your market before you write that letter.